Good afternoon, everybody. We're joined again by Bryn Kelly of The Fundamental Angle. Bryn joined us last week and she gave us a great presentation on natural gas and why storage is not the only signal to look at. That presentation, if you missed it or if you want to hear it again, can be found in the video tab of our website. It's also available in the replay tab of the live stream. We're looking forward to another great discussion today. Bryn, thanks for joining us.
Thanks, Michael. Good to be here.
Yeah, it's great to have you. So I see the topic today is natural gas, a look at the 2018-2019 prices and hedging activity. You want to take it from there and tell us about the presentation?
Sure. The last week or so, the natural gas has not really been the exciting market to be in. There's so much going on elsewhere. So you kind of have to dig a little deep here to try to find some newsworthy things that are going on in the natural gas market. So this week I thought I would talk about just the structure of the hedges that a lot of the producers get involved in the market, since it's sort of that time of year. Unless there had been a rally earlier this year in natural gas, but it's been pretty flatlined the whole year. And now that we're over halfway through the year, it's time for producers to get their 2019 hedges on. So I thought it'd be interesting to kind of take a look at natural gas versus crude oil and maybe what you can imply from some of these strike prices on the hedges that were put on the last couple of years, and how that might be useful when looking at breakout areas in the markets, since we've been so range bound in natural gas. Okay, so I'm just going to go through the 2017 and 2018 hedges that some of these companies put on. And I just went through a couple of the different investor presentations for some of these producers. They're in no particular, it's no particular value which one I picked. It's except for to say that the market is the market. And so options, a costless caller, will be the same for everybody. So, there's no particular difference between many of these producers. So it's relevant to just look at examples from, you can just take them from, I used Pioneer Natural Resources only because that was easier to go through some of their slides, but it's really the same for everyone. And this is not at all me singling them out at all. And then I thought I'd sort of take a look at the retail margins in natural gas versus gasoline, just as a way to think about how price sensitive the market or the buyer consumer is in one versus the other, based on the structure of the way that consumers pay for gasoline versus natural gas. But first I thought, since the inventory number came out today, might as well just take a quick look at inventories. They reported an injection of 33, and you can look at a comparison. It's been the same story all summer, looking at this same week for all the prior years, going back to 2012. We're still running below slightly levels that we saw in 2014. The story hasn't changed. We just tick off week by week by week, waiting to see if it's going to cause a call to action.
Well, I'm glad that you brought that up. Sorry to interrupt. I'm glad you brought that up because I was going to mention, obviously, today, oil or nat gas has been trading pretty firm the past few days. And then on that data release, it seemed like it was a bigger stockpile than expected. And nat gas dropped about 1% right when that came out.
Yeah. And, the funny thing about that is, so the whisper number on the street was around 28 and the number came in at 33. in and of itself, that's not really bullish or bearish. The market's been firm because there's 12 weeks left now in the official injection season. We've ticked off 18. And so there's a storage bid in the market. That doesn't necessarily mean that's a bullish storage bid. It just means that, there's less and less weeks left, and there's going to be more competition to get those molecules, and there's plenty of room in the ground. So it's not like the buyers are being particularly curtailed by operational constraints. So you would expect that to sort of be there. I wouldn't call it aggressively firm, but it makes sense that we have a little bit of a bid in the market. One thing to note is most of the other regions are generally putting the same amount in the ground that they have in previous years. A lot of them have caught up quite a bit. It's, the sticking point is really the South Central. And so I just broke that out a little bit here. You can kind of see South Central in 2018 as a total versus all of the previous years, and then break it down further in salt and non-salt. And I think the comment I want to make about the salt storage is really that that's the most flexible storage. So you would expect it to react more to backwardation or contango in the cash market. And there's been a bit of backwardation, or let's say at least not much incentive to put gas in the ground. And so you can see kind of that's why you've got the salt area sitting as low as it is. Those are, it's just like an option, right? And you look at the spreads between, balance of the month and next month. And it hasn't really economically made a lot of sense if you're running an option like flexible salt storage to put gas in the ground. So, all of these levels make sense based on, what's going on in the market. We've put in the ground this summer similar amounts, to date that we have in prior years. We just started at a lower balance. And it's the, $64 million question, how will that impact us this winter? You can run a scenario where if it's freezing cold and there are a lot of disruptions, we don't start the season with as much in the ground, that could certainly cause bigger price spikes than if we, for some reason, Mother Nature delivers a uber warm winter and, we kick the can down the road one more time.
So when do you think we'll have a better idea on that? Is it more of a November sort of time, when weather starts to get a little bit colder?
Well, there's a couple things. Obviously, as we get closer and closer here to reaching our end of season, till in the end of October, November, beginning of November, when, the caverns switch and you can no longer put gas in the ground, you got to take it out. It will really depend on what the weather looks like there. So barring any other strange weather event like hurricanes or something like that, it's really, we'll start to see it happen, I would guess, in November based on weather forecasts that start coming out. We might get some first looks at winter forecasts in October, maybe September, but waiting for those to crystallize a little more. So we're just sort of in this waiting game. We have October to wade through, which is generally a very low demand month. However, it's also a power generation maintenance month. So even though it's a shoulder month, there tends to be more gas demand from the power sector in October. October and April are really the two months that are heavily have a heavy maintenance outage schedule, just like refinery turnaround season, and they tend to surprise. One of the rules I always say is I never short shoulder months, because even though you can line up all the fundamentals and say how messy it's going to be, there's some underlying factors that tend to surprise people, whether it's electricity prices blowing out or too much electricity demand, and that kind of ramps up the gas, as well as fighting to get molecules in the ground for storage. So I would say, we're still ticking off time, as we have been all summer, waiting for the fall / beginning of winter. So that, long story short, that's kind of when
That makes sense.
I expected. However, market sentiment can come in at any point in time, right? And decide now is when they're going to load up either way.
Usually does.
Yep, that's right. So just all you have to do is be on the lookout for, that. It's not as if it's going to get away from you here. Okay, so I thought it would be interesting to take a look at the hedge structures that so many of these producers use, and I don't think anybody's unfamiliar with them. At some point in time, producers moved away from just outright selling futures against like next year's production, to this crafty little product that Wall Street sold to them called costless collars. And so that's why we always see, and I think somebody else talked about it in one of the other seminars, the call skew versus the put skew. And it's certainly based on, at least in energy, on the fact that the producers are the motivated market player in kind of drive a put skew versus call. So I just pulled out of Pioneers. Like I said, it's not like I'm picking on them or anything. It's just they had nicer slides, so it was easier to show the point. First, I'm starting with crude because it's interesting in how the market reacted above some of these strike levels. And you can look at sort of at the end of last year what they had for their strikes. And, all these producers do is based on where the strip is, they look for a premium neutral strike range and put that on. And of course, then they started moving their put price up a little bit and funding that with shorting lower out of the money put. But still, the goal was to just keep everything premium neutral so that they're not spending a bunch of money on insurance without, getting any benefit from it. I mean, you're always happy you have insurance when you have to make a claim on it, but it seems like a wasted expense when you go for long periods of time and you don't make a claim. So at the end of 2017, you can tell that they had pretty much put on all of the hedges that they needed for 2018. And that's pretty typical for most of these producers, right? They tend to get the next upcoming year as hedged out as they can. And you remember at the end of 2017, how low the market was. And so their strike range, let's just call it 47 to 57. Then we take a look at their last investor presentation for this year, and they're still not quite as hedged for their 2019 strip. I mean, obviously it could have changed since then, but really you know that all the producers out there are looking to pull the trigger. You can kind of wait all year. You don't want to lock down that range until you have a little bit more clarity on, and you're closer to, the upcoming year, and then you can kind of lock your strikes in around that. It looks like they pulled the trigger on some, and you can see they moved their range up from, it was 47 to 58, let's call it, and they obviously got their put price higher and their strike 52 to 61. So let's see what that looked like here. So the orange is the range of that collar. I'm just ignoring the lower premium for now, just because that's a whole different story if that comes into play. So this is really the NYMEX month one futures price. And here's our storage level weekly. And I just use Cushing because it's more directly correlated to WTI. So you could see they're, sort of feeling really good in 2017, actually probably had to make a few claims against this put price that they bought. But for the most part, we're able to kind of sell, within their range and felt protected. Then all of a sudden, you kind of have a perfect storm. So at the end of 2017, they're layering in for their 2018 callers, and the market was fairly low. They probably would have looked at that back in, summer to fall. And so that's where that 47 to 58 range came in. And interestingly, at the same time, we also had really low levels at Cushing, and coincided with some of the OPEC cuts, and that's really what I think helps some of these markets break out of their range, because we're going back and forth here. We're not hitting 58, everything's fine, and then all of a sudden, a little pain is starting to be felt, and for the most part, that's been pain all year, if you want to call it pain. I mean, it's lost opportunity. So they've all given their oil away at $58, 57 and change in 2018. And that means a couple of things. Number one, when you're getting called away, you have to produce it. And number two, you're only going to capture that market price on incremental production. And so one of the reasons you see production going up, it's not only because prices are higher, it's also due to the fact that a lot of these producers have given away the majority of their production. They were called away at 58 for this year. And you could see from the previous slide, as of the last report, they had 30%, that's in the Permian, but they have some portion hedged for 2019, and I'm sure a lot of them were waiting as crude oil was rallying, trying to see, after suffering through this year, finding a better range or level based on this forward strip right here. And of course, with the backwardation that we had in the market, we just couldn't get the back of the curve to lift up. And, I'd imagine a lot of them were waiting, hoping that might, filter through and they get a chance to reset at some higher levels. So bottom line in that is that I would expect, and you would expect now, and perhaps that's why the back of the curve hasn't really moved that much anyway, is that all the producers are sitting there waiting to lock in their 2019 hedges. All right, so how does that compare to natural gas, which is the topic of this anyway? So let's take a look at the same company and their strategy, their callers in natural gas. They do some things to hedge out their basis, but let's just look at the structure that they've put on for insurance. So at the end of 2017, they had their range set from 296 to 360 and had put some hedges on, looks like 35% for 2018, similar strikes, because we know the strips in natural gas just have not been moving. And so it's not too difficult to go out there and look at the Cal strip and then just figure out what the zero cost collar is. And then we come over here in 2018, and they're most recently reported, they're still not as much hedged as they had been in 2017, but they've, very similar strikes and nothing for 2019. And interestingly enough, if you go back and look at the same chart for natural gas that we did for crude oil, we've got our inventories for the total lower 48, month one futures prices, and then our collar range, the put and call range for 2017 and 2018. And you can see that really they had been waiting kind of right around here for this, any spike in prices in the winter that might pull the calendar strip up, so that they could layer into a better range. But, natural gas wasn't having it, and not, really couldn't budge the calendar strips. And so we're sitting here at a similar range. And here we are at this same point this year. Everybody's eye is kind of on, will these winter months rally enough to lift this calendar strip high enough, to give them some different range. So that's something I'm certainly, keeping an eye on. But it also says we just can't seem, unless we get to a point, and we certainly, as we saw with crude oil, right, the sun, moon, and stars kind of lined up. We had this lower inventory and supply condition that lined up with a breakthrough of the upper, hedged strike. So we've got another shot at it this year in natural gas. We're certainly sitting at lower inventory levels this time of year than we have for other years. And if we get some sort of, if that could filter itself in, these hedges let's say they get placed at the same level for 2019, maybe we have a shot at breaking through those to the upside. It's certainly caused a lot of complacency over the years, especially when you get to make a few claims here on your insurance, but for the most part, you haven't given away anything on the upside. It's a better feeling as a hedge than completely lose, having to make a claim all the time, or losing out on opportunity. So the whole point of this really was, let's think about what are the conditions that could show up this winter that could push us out of this range, one side or the other. I would say if we break the bottom end of the range, they'll produce the amount they have, quote unquote, insurance on, right? They're put, but certainly nobody's going to be tripping over themselves to produce any extra. And that could be an interesting scenario for natural gas. Same thing if, they get called away and suddenly are needing to try to figure out how to bring excess supply to the market. And this is just a look at the continuation chart of the actual calendar strip. Here was 2018 strip before it expired, and now we've got the 2019 strip, and you can see that it's just sort of languishing here, around this 290 level. Everybody, all the producers' eyes are on it. They'd love nothing more than for the winter months to rally and sort of drag the rest of the curve up, assuming March, April doesn't blow way out as a result, and summer actually sells off and keeps the curve flat, which is oftentimes why that March, April spread tends to move. It's less of a bullish indicator and more of a anti-summer or anti the entire curve type of spread, keeping the calendar strip unchanged, even though the winter months are moving up. And I always find it interesting. You can find, where this opportunity cost or loss is at all these producers when they report their derivatives losses. That's essentially their hedge, right? And of course, you would expect, based on the chart we looked at, right, you can see in 2017, It was 103, and now it's almost doubled in 2018, which makes, of course, sense, right? When you look at the market versus that upper 58 bound. And anybody who's into researching and trading a lot of these equities, this was for, I think, second quarter earnings. So you would expect this to just continue to build the rest of this year, as long as we're above 58. So the delta between 58 and where futures prices are, you're just going to continue to see these, I guess, derivative losses build up, and they're not immaterial. I mean, in this case, it's $1 a share. So just, I point that out as, fairly, it's going to be expected. And hence why these equities have not really moved as much with energy prices, and specifically crude oil prices moving up, because most of them weren't participating for a majority of their production this year. All right, so hedging is for producers, AKA it's good to be in retail. What do I mean by that? The reason there's always, so much talk about producers hedging in the market versus the consumers, is that those who are consumers in the market can generally pass the costs on to their customers. For example, let's just take an airline at a high level, right? I mean, if we saw gas prices go back to $5 or $7, or electricity prices, you'd see that tacked on, on your hotel bill, the surcharge. You'd see the fuel surcharge on your airline ticket. I mean, they have some protection to cover themselves because everybody's in the same boat, whereas the producers don't. And I mean, that's nothing new. But you can see here we have Citygate prices for natural gas in the black line. And I'm using Citygate versus production just because wellhead production prices are so hard to really, they're so disparate around the country. So if we look at, delivered Citygate prices over the past several years versus LDC residential prices. So, it's quite the situation with natural gas and electricity that the tariff rates that are charged to consumers have so much fat in them that the actual end user, the residential consumer, is less price sensitive to moves up in prices because they're always paying a really high price. LDC prices for natural gas are $12 to $14 if you all in a lot of places around the country. So they have transportation charges, and there's just such a premium that's marked in. And even the trend, so the yellow is the difference between retail prices and Citygate prices, and you can see the trend going up as the spread, aka the margin, right, between what these regulated utilities are able to charge consumers. So even though natural gas prices have gone down significantly over the last several years, there's been literally like no change in the trend to tariff rates that consumers charge. And you just created a consumer that is just not that price sensitive in either direction, which is a different dynamic than we have in the gasoline market. And I took a few liberties here. You can sort of take the retail price of gasoline and the cost to produce. So it's crude oil times an 11% refining cost versus US spot retail gasoline prices. And such a different chart because you just get such an even spread between the cost of production versus the price at the pump. And it's number one, there's a very informed consumer. Gasoline prices are very transparent, and people know how they buy it and how they use it. You know exactly what you're doing. It gets a little foggier, when you think about your electricity and how much natural gas was used for that, or just even, the natural gas coming into your house. It's not as transparent as putting gas in your car. And so consumers are very responsive to changes in, the outright production cost. And it changes the whole dynamic really in the overall market. And it's something people don't talk about that much, about the retail user of natural gas and electricity really have not been afforded the benefits of this low natural gas price. All that's happened is that tariff rates have they've spent more money, they've added more capital costs at these different utilities, and then they just jack up their, added into their rates, and rates sort of relative to cost of goods tends to rise. So that generally overall, like I said, the natural gas market's been a little flatlined. So certainly looking for things that might show up that, to keep your eye on, to look for something to break it out of, either side of the range. And, happy to have any questions.
Yeah, well, that was great information. Thanks for that, Bryn. I actually had one question kind of following up. You keep referring to winter being very important to natural gas prices. I remember a few times over the past decade or 15 years where nat gas has really been weather driven based on hurricane season. Is that something that could be a catalyst if there's a big storm in the Gulf or something?
So great question, because since 2010, I'll just say, we have, for every barrel that molecule that we've stopped producing offshore, we have started producing onshore, and specifically in the Marcellus region, it's almost been a 1-to-1 offset. So there is less supply at risk sitting in the Gulf that would be impacted by hurricanes. There is a lot of infrastructure in and around the Gulf Coast that could be impacted, but it's in a different way. These days, what people look at for hurricanes is loss of power, meaning loss of demand. And I think that's been partly just, the market learns over time, and also just the shift in where everything is produced, and that there ends up being more demand at risk than there is supply at risk. But there's certainly, hurricanes have shown us, right, that it could run right up through Louisiana and take out the Henry Hub infrastructure, something like that, right?
Right.
But less so the actual offshore production.
Interesting. John's asking a question. Going back to that gas slide, can you explain crude or RBOB prices versus what I pay at the pump? I guess more of a detailed, with taxes and different.
Let's see, where was that?
It was towards the end. Yeah.
Yeah. So generally, you can. So as a back of the envelope, you can take crude oil prices times, 1.43, and then divide that by 42, and you can kind of get what your market price of RBOB is going to be and come fairly close. So that tells me that, this sort of estimate of 18% taxes, the transportation
where'd you get 1.43 from?
57% of the cost of gasoline is crude oil.
Gotcha.
The other 43% is, great, I should clarify that earlier. And the other 43% is taxes, transportation, and the refining. So you could consider refining and crude oil together, right? And then just add on your taxes and transportation. But it is a lot less than it is in electricity or natural gas, and certainly regional, right? It's why we pay so little for gasoline in New Jersey. We're right by, the New York Harbor Terminal versus the middle of the country like Chicago.
Right. And
So
so,
our
so
futures, right, are essentially it's a margin, right? So the crack spread, you're either going to get paid 11%, which is your cost of refining, or you're going to get paid more than that. And a positive crack spread says you're getting paid more.
interesting. And so, are you saying that electricity is we're more price sensitive to an electricity move than we are to an oil move?
Um, let's see. I was saying that the cost to transport and distribute electricity and natural gas is higher.
Oh, okay. Gotcha.
And in reality, you think about it, to get to electricity, you're taking an input fuel and further transporting it, incurring losses in that transportation, then quote unquote refining it into electricity, which also generates loss of BTUs, then putting that on a transmission line, which also incurs BTU loss to get it to its final destination. So much of the difference in cost is that you lose a lot of BTUs going the further down the chain you go.
Interesting. And, kind of on that subject, kind of off the subject of this other stuff, but I'm just general question here. What's in the in the electricity market, what are the biggest, what are the different opportunities that cause possible spikes in prices in electricity?
Well, electricity is the ultimate lack of storage commodity. And so price spikes happen in real time, right? Intraday, when you've literally moved your demand into a higher priced dispatch stack. And the dispatch stack, right, is just the group of units and their economic production costs, and the least cost one will be dispatched first, and then the next one. So you could have, if you all of a sudden drop a unit, like a big nuke unit goes out, you immediately shift to a much more expensive replacement unit, and it happens immediately. There is no storage to go draw from. The storage is literally excess capacity that you have sitting around. Which is why people are, so keen on batteries, because the only thing we have is just more production, excess production sitting around in natural gas. In electricity. So within the day, it's really demand exceeding supply at a particular price. And sometimes that's known as it just gets hotter and hotter throughout the day. And sometimes it's unknown based on a loss of a unit or a transmission line having problems. Or, same on the other side. All of a sudden, a big storm rolls in and air conditioning load drops significantly. They've got to back off units enough to keep the grid stable, which then can cause prices to go negative. So within the day, it's very much, just cut and dry the economics, aside from any sort of various tactics that might go on within a particular ISO. It's really the supply and demand curve, which tends to move forward prices one way or the other, just as in any other commodity. Not to the same extent, however, just because if a unit's down for the next 15 minutes, it's not going to be down next month.
Right. It's all about short-term sort of supply demand on that. Interesting.
Correct.
So I thought it would actually be pretty interesting if you could kind of take us, if you could tell us on a different topic, not at all on what we're talking about. You've been in the industry for so long. You've worked at amazing names: Cargill, Coke, BP, among other names. Tell us about your experience back in the early 2000s around Enron, around that whole debacle. What was your experience there?
Wow, so that brings back memories. It's funny. So I think I started at BP in 2000, January of 2001. And to be honest, at the time, it was during the Enron heyday and going on to run a energy desk at a energy firm, like a big oil firm, seemed like not a very great choice. And it turns out that it was, but it wasn't considered as sexy as, getting, onto one of the banks that was really getting hot and heavy into energy, or Enron, let's just say. And then all of a sudden, the Enron bankruptcy rolled around, and was that 2002 or three, whatever it was. And all I remember is, at the time, so many transactions there. There was an ICE clear. So all the buys and sells, essentially futures, right? But they were all the bilateral futures contracts, were done with a specific counterparty. So you ended up, with a whole list of, your position might be net zero, but you've got a massive book full of credit exposure. And, there was a time when that wasn't really considered a risk. And then, there were some various small bankruptcies that made people a little bit more aware, but nothing like Enron, where all of a sudden you had to take your entire database full of hundreds and hundreds of transactions that you had done over the years. I mean, a couple of years ago, you could have sold, Cal 2005 and bought with Enron, and bought it from Merrill Lynch, and you're flat, you've booked the P&L, and now all of a sudden you don't have one leg of that trade. And for me, I thought Enron they were helpful. They essentially, you'd call them every day and you'd tell them the list of transactions that you had with them, and they would find somebody on the other side, and you would essentially do a book out. And so we spent weeks and weeks just going through all of these transactions and getting to book them out. They also kept Enron Online, their platform, up. And so you could peel out all of your transactions that were just with Enron, and then just do the opposite directly on Enron Online. So from that standpoint, it was crazy to have to do that. And then it came down to, what was as a company, did you have a net gain or loss with them? And if you had a gain, you probably weren't going to get it. You really was better to have a loss with them. And I think, if I remember correctly, it was fairly flat to, a loss. And the way that legal entities were used across, you do certain things, a company's under one legal entity name and another, and those were able to, some be offset and some not. So I give a lot of props to BP and how their legal entity structure looked. And apart from being just, who would have ever thought that would happen, I will say they were very, as far as going through the book out process, it was pretty, we were lucky that they all stayed and worked and let everybody offset with them.
It sounds similar to the Lehman days. That was similar, like exactly, whether it be fixed income exposure or currency exposure. Like you said, people might have had trades for years prior that, Lehman might have been the counterparty, or, might have been a middleman. Right. And then, it's a debacle for months and months. And
yeah, and I mean, like I said, they weren't just gone the next day. They were still, sort of conducting business, just not doing new trades, but essentially booking out with everyone. And I think that made a difference. I mean, it could have been a lot messier. I'm not saying it wasn't, but it could have been a lot messier from just an everybody's book across the industry standpoint.
Did you have to scramble to do any transactions based on exposure or anybody, things of that nature?
The only, so that would have only mattered with the current month. So, as you came to delivery or expiration, right, of the, current month's contract, today, your futures contracts just go off the board. And, there were futures then, but most of the trades were done on ice and they were bilateral. And so when you got, so now it's August, right? At the end of August, you would know your net position going into September, and you have to go and essentially schedule all of these buys and sells, and you book them out. So for any schedules that were actually currently flowing, there was some risk, but there wasn't, and it wasn't like back in the day when City Water, Light and Power in electricity just folded one day and cut all your schedules and nothing flowed at all, and you had to go out in the market and replace your electricity with $2,000 electricity. It really, there weren't a lot of actual flows on paths that got cut. So from a prices in the market aspect, I mean, I could be remembering it wrong, but I don't remember it actually was as big of a price disruptor as some of the smaller bankruptcies that I remember in the electricity market in the late 90s.
Interesting. Well, I'm sure it was a crazy time. And now, in hindsight, you can kind of look back at it calmly, but I'm sure it was a bit chaotic beyond chaotic at that time.
Oh, yeah. I mean, all of a sudden, everybody cared about your balance sheet. And, here I am, so, BP, it's like, what do you got? I've got BP's balance sheet, I mean, you didn't think about that as much prior to that. It was just like, who would let you do the most trading? And then all of a sudden it became, oh my God, you're at, your company's got a great balance sheet. I mean, I had worked for Aquila a few years prior, and that ended up being sort of the nail in the coffin for them on, these similar to Enron. They were operating a massive trading operation with a triple B minus balance sheet, and, caught up to them.
Yeah, interesting times. Well, thanks for that, going back and letting us know about the Enron days. And also, great presentation, another fascinating presentation on the energy market, and a lot of great facts there. Thanks for taking the time.
Great. Thanks for having me.
All right, look forward to talking again soon.
Okay, have a good one.
All right, you too.